This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun, our CEO, and we're going to talk, as we always do, about the report he writes for this week. So we're going to go through the written report. And Joe, one of the questions I want to ask you first, I hear this a lot out there. With all the volatility that we've had, is the sell-off over? Big question.
Well, everybody wants to know the answer to that, right? I honestly don't think it is. I think it would be awfully convenient if it was, but I don't think so. It's interesting. We follow market sentiment a lot because, we tend to be contrarian, but being contrarian is not just a matter of being opposite of what everybody thinks or kind of what the trend is. Being contrarian means being contrarian at extremes. When everybody thinks the market can't do anything but go down, then you can start looking at it to go up, because essentially once that happens, everybody that wants to sell is already sold. We don't see any extremes in sentiment right now. It's interesting, though, because you get this dichotomy between what people say and what people do. And so if you look at the surveys, Investors Intelligence and American Association of Individual Investors, people seem to be pretty bearish. But when you look at the market and you look at how they're positioned, you look at the options market and you get just the opposite. Last week, we saw index put call ratio, I think, was around 1.07. That's not even, we want to see that number well over 2 to 1 puts to calls at a bottom. Same thing with individual equities options. We want to see an equity put to call ratio over 1. Well, we're not even close to that. The peak in this little sell-off that we've had was only 0.82. So, sentiment is fairly negative, but we're not really close to a bottom yet, I don't think, as far as sentiment is concerned. Now, how much that requires as far as movement of the market to reach that extreme, I'm not sure. And I would say, too, by the way, that the NASDAQ did reach a pretty low point with only 18% of the stocks in the NASDAQ above the 200-day moving average. But that number can go to single digits, too. So we've seen that in past sell-offs. So like I said, no, I don't think we're there yet.
Well, you kind of alluded to this. Looks can be deceiving. So talk to me about the underlying facts, first of growth stocks and then NASDAQ and S&P.
Well, growth stocks, and you can look at that in a couple different ways. I look at the S&P 500 growth index. I look at the NASDAQ, QQQ, whatever you want to look at, the things that encompass the growth stocks, and just look at the S&P 500 itself, which is, in a sense, because it is a market cap weighted index, means that it is essentially a momentum index, which means that at the moment it is mostly a growth index. But anyway, listen, I just like to look at trends, big picture trends. Big picture trend to me is how these indexes are, or ETFs, if you want to look at the ETFs, how they are in relation to moving averages. Moving averages are nothing more than ways to smooth out the ups and downs on a day-to-day, week-to-week, month-to-month basis. So what we look at, and this is convention, this is, it's not anything that's really scientific. It's just what the world of investing has decided on or agreed upon. Indexes or stocks or index or ETFs or whatever that are below their 200-day moving average are generally considered to be at a downtrend, and ones that are above the 200-day moving average are considered to be in an uptrend. Now, you can refine that somewhat. We also look at the 50-day moving average and its relationship to the 200-day moving average. So when the 50-day moving average is above the 200-day, you're in an uptrend. When it's below, you're in a downtrend. Well, the fact is, in the NASDAQ and the S&P 500 and the S&P 500 growth index, we're in a downtrend. Those indexes are all below their 200-day moving averages, and the 50-day is below the 200-day. That's just the facts. Now, when you look at some of the other indexes that we use, the dividend indexes and the value indexes, that's not true. They're still in uptrends. I'm not saying they're in great uptrends, but they are in uptrends. And so that's, just a big picture. You want to see what the trend is, because you need to kind of follow the trend, and that's where things are right now. So the growth stocks for sure are not done yet.
Well, if you look around the world, where are the best valuations right now?
Well, I think that, we have an international value ETF in our portfolios, EFV, which is the EFA value index. It's got a dividend yield over 4, and as I said in the piece, it just reads like a laundry list of blue chip stocks outside the U.S. I think that's a real cheap place to be, but if you're going to invest there, you need to have at least not a headwind from the dollar. The dollar has been rising. It's in an uptrend, and that is a headwind for any dollar-based investor investing outside the U.S. because you're going to lose money on the currency. You could be in a situation where the index that you're following, whatever international index it is, goes up 5%, and the dollar goes up 5%. And you're nowhere. You didn't make anything. So I think that while it's really cheap, and we do own some, we think the dollar has been stuck in this range for a long time. We don't think there's a lot of upside to it here. It's at the top of the range. It's probably going to come back down. So we're willing to hold that because the valuations are so much cheaper than the U.S. That's kind of where we see the cheap stuff. Look, you can make an argument that the emerging markets are really, really cheap, and that's true. But there's also a risk involved there that we don't that we decided we couldn't take anymore. We had a position in emerging markets, but with the rising dollar, it makes it very difficult for those markets to outperform. And in addition, you pick up, in this case, Russia and China risk, although the Russia risk has now been eliminated because Russia's been eliminated from the index. But you do have China risk too. And a lot of our clients and us too, we're not too crazy about that risk at this point. We do think China is really, really cheap, but there's a lot of risk there.
With all the swings we had last week, let's talk specifically about three things. And you've been talking a little bit about that, but the dollar.
Yeah, the dollar was down last week. We got to the top of the range, a little above 99 on the dollar index, and we pulled back last week to 98.30 or so, 98 and a quarter, something like that. We've been in that range for 7 years, where 90 is roughly the bottom and 100 is roughly the top. We've been in that range since 2015. There have been some outliers up to 103 in 2020 during the onset of COVID, and we've had some outliers to the downside to say 88 at various times during that 7-year period. But the fact is, it's been in that very narrow range for a long time. We're at the top of the range, and if past is prologue, you got to assume it's going to head back to the bottom of the range. Why that's going to happen, I don't have any idea. And I don't know for sure it's going to happen. I mean, we have to watch these things. We can make that assumption, and if it follows through, then great. If it doesn't follow through, then we'll have to change course. Right now, that's kind of what we expect, is that you're at the top of the range. You'll start to work your way back to the bottom of the range over the next few months or over a course of whatever time that takes.
Next, the 10-year Treasury and the yield curve.
The 10-year Treasury is still in an uptrend. We hit 225 last week. We're trading about 223 this morning. That is a high for this cycle since the onset of COVID. That continues to rise for a variety of reasons. We did see last week too, tip yields did rise. So inflation expectations were fairly stable last week. But look, it's a rising rate environment. That's what it is. And rising rate environment is one that tends to be a little bit of a headwind for stocks. I mean, think about it. The S&P 500 yields 1.2 or something like that, 1.3, whatever it is. Well, you get almost 2. You can get, actually this morning, you can get 2% on a 2-year Treasury note. So you take a lot of risk to pick up that dividend yield off the S&P, whereas you can get a better yield from a 2-year Treasury note with no risk at all. So anyway, the point is that we're in an uptrend. Then we look at the yield curves, and yield curves are flattening. There's no doubt about it, especially in the belly of the curve, where we saw the 10-year, 5-year invert for a day or so last week. But the fact is that inversions in the belly of the curve don't mean all that much. I pointed out, I think, 5 or 6 times in the past since the 1960s where the 10-year, 5-year inverted, and you were still over 2 years away from a recession. So what does that mean? I don't know. It means, I guess, you should think about it. I don't know that it certainly doesn't mean you need to do anything. The 10-year, 2-year curve, which is the one that everybody watches, although all the research that I've seen, Harvey Campbell and so forth back in the 80s is based on the 10-year, 3-month curve, but whatever. 10-year, 2-year curve seems to be the popular one. It last week closed about 17 basis points. It was trading about 23 this morning, I think. So we're not flattened. We're not flat. We're not inverted, but we are flattening. All that means is that future growth is going to be lower. And that's all it means. If you invert, then yes, history says you're going to get a recession sometime within 6 months to 2 years. I can't get any more accurate than that. That's as close as you can get. For equity investors, by the way, if you get out 6 months before the onset of recession, or within a window of 6 months before to 6 months after, you're probably going to be within about 10% of the high. That's what history says. So yeah, yield curves are flattening. It's a means, like I said, you're going to have slower growth in the future. And that future, in the future is the key phrase there. You're talking 12 to 18 months out. That's what all the research says, that yield curve movements predict economic growth 12 to 18 months out. Anyway, so yeah, they're flattening. It means that growth's going to slow at some point in the future. Not exactly shocking since we grew at nearly 6% last year. So yeah, we're going to slow down.
And then what about commodities?
Well, commodities were down last week. Oil prices fell. Although, listen, commodities in general, I thought were fairly stable last week. It was crude oil that really took a hit last week. We hit 130 on the, right when they invaded, Russia invaded Ukraine. That did not last. You've traded all the way down to 93 and change last week. As I said in the piece, I think it's mostly about this realization that Russia's still selling oil. And that doesn't appear like it's going to change, which means that really supply hasn't changed all that much. We'll see what happens on the demand side. We have not seen any demand destruction yet outside of, obviously, Ukraine. United States gasoline demand last week was up from the previous week and from the previous week and from the previous week and so forth and so on. So we are not seeing any slowdown in the U.S. as far as consumption right now. We may see some slowdown in Asia, though, as they've got a new COVID wave going on there in China, Hong Kong, and even in Korea, too. So we may be seeing some demand destruction over there because of COVID, but we really can't quantify that yet. So anyway, the point is that the commodities were down last week. But I'm going to tell you, this oil market is extremely volatile. We're back up to 110 this morning. So we're kind of back where we started at the beginning of last week. I don't know exactly what's driving this. We've still got a very steep backwardation in the curve, where future months are trading at a big discount to the front month, which means there's a lot of demand for the upfront, oil in hand, so to speak. That'll end at some point, but it hasn't yet. So it's an interesting market. We do own commodities, as we've talked about many times. It's the thing that kind of has bailed us out in this thing. We haven't seen much of a hit for our portfolios because we own commodities. That continues to be a position we're going to hold. It's a strategic position. It's not something we're just going to get rid of.
And then last thing today, pretty good week for European markets, consumer cyclicals, and financials.
Yeah, it's interesting. European stocks are essentially back within a couple of percent of where they were prior to the Russia-Ukraine onset of the war. I think that one of the things we've discovered during this war is that the conventional forces of Russia really aren't much of a threat to Europe. They performed horribly in Ukraine. Putin, I don't know exactly how this thing is going to go. I still think Ukraine is in a very, very difficult position here because the Russians, Putin in particular, does not seem all that concerned about things like civilian casualties. This thing seems to be turning into a bit of a stalemate, which is good and bad, I suppose. Bad in the sense that Russians can just set off and lob artillery into all these cities in Ukraine and eventually, kind of a medieval siege and eventually maybe win. But again, I think that the key there for the rest of Europe is, well, if they can't take Ukraine, I think the odds of them taking anywhere else in Europe are pretty low. Doesn't mean they couldn't stir up trouble, but I don't think they could do much. So maybe that's why Europe recovered last week. I really don't know. Europe was actually up more than the growth stocks in the U.S. last week. So Europe had a very good week. We'll see where that goes.
Consumer cyclicals was the next one.
Yeah, look, the economy, we just got a Chicago Fed National Activity Index number this morning at a 0.51. It says that the economy is continuing to grow above trend. People got all excited a couple of weeks ago when the Atlanta Fed GDP now went down to 0. And it's back up to 1.5, and my guess is it's probably going to continue to trend higher. Citigroup Economic Surprise Index is positive right now and continuing to do pretty well. We've had some reports that were not that great. Existing home sales weren't great last week. We had the New York Empire State Fed reading was not that great last week, but the Philly Fed was okay. So, it's kind of mixed. So cyclicals did okay. Cyclicals had been kind of kind of beaten up a little bit. Financials, I think, is more interesting though. Financials were up big last week, and theoretically, a flattening yield curve should be negative for things like banks because they lend across the spread. But I think what it goes to show is that banks they're not borrowing money at the 2-year Treasury rate. That's not the way this works. I don't know if you've checked your savings account balance lately or looked at CD rates, but I can tell you they're not rising as fast as Treasury rates are. So they've still got a decent spread. And so my point is that there's this idea out there that a flattening yield curve means, oh, well, banks won't lend because the spread's too narrow. And that's what causes a slowdown in the economy. And I got to tell you, the evidence all says, yeah, that's not true. I don't have any idea whether an inverted yield curve actually causes a recession or it's just an indicator of recession. I have no idea. But everything I've read, everything I've seen as far as lending is concerned, it doesn't make sense. So banks, financials did pretty well last week.